The middle powers must act together because if we're not at the table, we're on the menu.
Somewhere Europe has to grow out of the mindset that Europe's problems are the world's problems, but the world's problems are not Europe's problems.
चुन चुन करके हिसाब लेना ये मेरी फितरत है.
Why should it be a problem? If I'm smart enough to have multiple options, you should be admiring me.
भारत झुकने वाला भी नहीं.
The rise of India will be determined by India. It will be determined by our strength, not by the mistakes of others.
The old order is not coming back. We shouldn't mourn it. Nostalgia is not a strategy.
Hey guys, welcome to my channel. If you enjoy the deep analysis on global power shifts, trade, energy, and the changing world order, make sure to like and subscribe. So let's get started. Now, India is the fourth largest economy in the world. It has already surpassed Japan and is expected to become third largest economy very soon. And if my calculations are right, then it should happen by 2028. But here is something very interesting. Okay. Even though India is now one of the biggest economies on the planet and one of the, not even one of the, actually the top largest growing economy, the major economies that is on the planet. But the rupee, that is Indian currency, it still behaves like the currency of a developing world or developing country. By that, what I mean is that it behaves like it doesn't belong to the country whose economy is growing so fast and who is supposed to be or who's going to be the future superpower. In fact, countries with smaller economies still have currencies that carry more weight, more global weight actually. Like for example, the Japanese yen, the British pound, even the euro, all of them are treated as serious global currencies. But the rupee isn't. So the real question is not why the rupee basically has depreciated so much. If you look at the numbers, then in past 10 years, rupee has fell all the way from 60 something to $92. $1 is 92 rupees. So the real question is this, okay? Real question is this, that why does a country as large as India still have a weak currency? To understand that, we first need to understand how currencies actually become weak in the first place. And that's what we are going to talk about today in this video. And before we get going, please do like and subscribe, and let's get going. Let's get started. Let me share my slide with you. Okay. And here we go. Why India, the fourth largest economy, still has a weak currency. See, before we talk about India, we need to understand a very simple mechanism that determines why currencies become weak. The currencies become weak, or currencies usually lose value in two ways. The first is called depreciation. Depreciation happens through the market. What does that mean? Market means that when businesses, investors, governments sell more of a currency than they buy, and its value falls relative to other currencies. In other words, for example, when a supply of a currency in a foreign exchange markets becomes larger than the demand for it, the currency depreciates. What does that mean? See, all the currency trading, there is a market called forex trading, that is global currency trading market, exchange market is there, where uh, lots and lots of central banks, they put their currency for trading. Okay. Like, for example, a very good example would be the PACM, that is PACM, Pan African Currency Market. Africa has its own currency exchange market, actually, if you didn't know. So, what happens over there in the currency exchange market is uh, that when investors or the buyers they start to sell rupee, which means that rupee gets collected in the foreign exchange market a lot, right? It piles up. That's called selling, right? And that means the rupee actually is increasing in supply over there, and nobody is there to buy the rupee. Hence, rupee depreciates. And this depreciation happens because of the market conditions, because of businesses, investors, government policies. Okay. So that's called depreciation. The second way is called devaluation. Now, devaluation happens when central bank deliberately pushes the currency lower through the policy decisions. What does that mean? It means the countries sometimes what they do is that they depreciate or they devalue their currency to support exports, improve trade competitiveness, or manage structural economic pressures. So, whether it happens through the market driven depreciation or policy driven devaluation, the outcome is the same. It's the currency that is hurt in the process. That is, currency loses value relative to other currencies. Now, once we understand this basic mechanism, the next question becomes clear. Then why does Indian rupee face this pressure so consistently? Right? You have to ask this thing to yourself that, yeah, okay, we all know what depreciation is, what devaluation is. Fair enough. One is market driven, one is policy driven, the central bank policies. So the question is that why central bank has to make policies like that all the time, right? Or why the currency has to depreciate all the time? Why can't it just be stable, right? Even Japanese economy has gone all the way to the rock bottom, but their currency didn't even tank like rupee normally does, right? So when we look at the structures of the Indian economy, then several clear reasons begin to appear. And those are the reasons that I'm going to talk about, and I'm going to explain you what exactly is going on. And this is going to give you a very clear picture of the macroeconomic changes and the microeconomic changes that are made or that happen behind the scenes that we normally don't see, but they do hurt the economy. Okay, so let's get going, let's get started, and here we go. We talked about it. And number one reason number one, as you can see on my screen, is the India imports more than it exports. See, this is the first reason, that India's large merchandise trade deficit. This is the primary reason. Now, if you look at the number, then you see that in recent years, India's goods and services exports together have crossed roughly 820 to 850 billion dollars annually. Now you have to understand that this is goods and services. I'm not just talking about goods, okay? But if you look at the imports numbers, then imports are even larger. That India's total imports reach roughly 900 to 950 billion dollars per year. That means the country runs a persistent trade deficit of roughly 80 to 120 billion dollars every year. What does that tell you? Let's take a brief pause before we move forward. Now, what does that tell you here when we look at this number, that we say that okay, there is roughly 80 to 120 billion dollar deficit every year, the trade deficit. It means that India has to print this much worth of money, rupee, to make up for that loss. Meaning that your money is going outside from your domestic market. This is the same problem that America's economy is facing. Okay. And because of this all this trade deficit and all that trade deficit, losing the manufacturing for America, hmm, they are in almost $40 trillion of domestic their dollar of the $40 trillion of national debt, out of which 65% of it that is domestic debt. Now coming back to India, now when this happens, 80 to $120 billion every year, your country loses money. Then what does that do? It creates deficit and it piles up on the national debt. Now let's look at the good side. Like we talked about total goods and services altogether. So, but the good side, goods, that is, good side tells a even more important story. So, if you look at the numbers, you see that merchandise exports roughly it is like 430 to 440 billion dollars, and merchandise imports it's 700 billion dollars. So this leaves a goods trade deficit of around 250 to 300 billion dollars annually. And out of this, if we put this in perspective, you will see that out of 250 to 300 billion dollars, almost 80 billion dollars is just the trade deficit with China. Okay, $80 billion trade deficit is just with China, and then almost $50 billion trade deficit is with Russia. So $80 billion plus $50 billion, that is $130 billion of trade deficit is just with between these two countries. Now this is why I made a video. This is why I made a video just recently, that why uh, my India's purchase of Russian oil could actually backfire on rupee. This is the reason that when you look at these numbers here, then you find just between China and Russia, the trade deficit is $130 billion. Now, if India continues to buy Russian oil and India continues to trade with China and Russia, then what's happening here? We're talking about from 130 to $150 billion if trade imbalance is not addressed, which means that rupee is going to further fall. Now, if you look into what happens with the uh, Iran war that's going on in the Middle East right now, right? Oil prices have already gone up, which means that import is going to go further up. Think about it. Import is going to go further up, but exports wise, exports don't go up as rapidly as imports does. Why? Because a major chunk of import is your oil and fertilizer, or certain essential things. Okay, but so this is why, because once the oil prices go up, this import immediately goes up, it jumps, right, it spikes, but exports don't spike as rapidly, right? So this is why you see a good trade deficit of around this much, and this may rack up. So as I told you the number earlier, that just between China and Russia, this trade deficit, that like half of the trade deficit that comes, it just comes from China and Russia. This means India consistently needs foreign currency to pay for imports. Now you understand why India is not a very good supporter of de-dollarization. India is not a proponent of de-dollarization like normally the de-dollarization lobby would like for it to do, but India does not. So, whenever a country needs more foreign currency than it earns through the exports, its own currency naturally faces downward pressure. Okay, that's the reason number one. Now, let's get into the reason number two. The reason number two is energy dependence. The second major reason is energy dependence, as we all know this, right? Now, India's imports roughly 85 to 90% of its crude oil needs. 90%, think about it. And this makes India the third largest oil importer in the world. Third largest. Depending on the global prices, India's oil import bill typically ranges between 160 billion and 200 billion dollars every year. So I gave you the number earlier, right? The number was 700 billion dollars in imports, out of which imagine 200 billion dollars up to this much is just the oil, the crude oil. And out of which is almost 60 billion dollars that comes from Russia. Okay, 60 billion dollars, meaning that trade deficit that you see in this is all 60 billion dollars, pretty much 50%. Like 50%, think about it. That trade deficit comes from just two countries, Russia and China. The oil is not just another commodity, okay? It powers what? Transport, manufacturing, logistics, agriculture, electricity generation. So whenever oil prices rise, India's import bill rises immediately. Because these are the necessities, right? Necessities, these commodities, you just cannot change that. So when the import bill rises, India must sell more rupees to buy foreign currencies like dollars. And even if you are trading in the national currencies, like lots of people may argue here that, hey, but India is trading in the national currency, right? So why there is a problem? Yes, India is trading in the national currency, but India is still trading. So regardless of the currency, don't think of it in terms of currency. Think of it in terms of profit and loss. So deficit simply means loss. It does not mean profit. So that's what the problem is. And this directly puts pressure on the rupee. Every time oil prices go up, currency will go down. Why? Because imports immediately go up, right? Otherwise, if you go to the previous slide, just little bit, okay? I'm not gonna spend too much time on it. If you look at this, the exports once again, it stays where it is, but imports immediately they go up $700 billion plus. So then as the number goes up, imports goes up. So meaning that it creates more and more trade deficit for India. And trade deficit for in creating more trade deficit for India, meaning that rupee will depreciate. Make sense? All right. Now let's move to our third reason. This is even more important reason. So it is called India's manufacturing and export base, which is still developing. That falls under what? Make in India, and it's branded and sold as made in India. Okay. So currencies usually become stronger when countries dominate global manufacturing exports. For example, China. China pretty much dominates in everything. Then look at Korea. Korea Samsung dominates the semiconductors. Taiwan dominates the chip manufacturing. Then look at Japan. Japan used to dominate the semi electronics market and the car market. There was a time. So Japan built its currency strength through decades of exporting what? Automobiles, electronics, industrial machinery. Germany built enormous manufacturing power inside Europe. That's German engineering is just famous. I mean, Germans were the ones who invented V2 rockets. That the rocket technology came from Germany. China became the world's manufacturing hub over the last 3 decades. Like almost for past 40 years, China has just dominated. Look at all the rare earths, electronics, semiconductors. China beat even the top semiconductor manufacturer and semiconductor based countries, right? So, if you ask me, what is India dominant at when it comes to manufacturing and export? Honestly, honest answer is uh, India has exports, but India's exports are not completely dominant in pretty much anything. Yes, pharmacy and all is there, but India is not dominant in it. Okay. And in fact, that creates the general pharmaceuticals actually creates even more dependency for India. Why? Because general pharmaceuticals actually, you have to understand one thing about them is that India has to get the patent, the permission to use that to actually manufacture it, even though still it's the Western countries who come up with the formula, and India just manufactures it for the countries so that it is sold cheaper. All right, now you get the picture. All right. So it's not all doom and gloom. Okay, I'm not making this video to talk um bad about a country I love. Okay, so let's not do that. I'm not doing that. I'm just talking about uh the general things that people tend to not understand. Okay, and this actually can have impact on India's domestic policies too. So the why the imports are more? I'm going to get back to this manufacturing, okay, but let me explain you another thing um, about the imports, why it's too much. See, what happened is within the Indian politics, Indian domestic politics, is that uh, for a few years, up until up until before 2014, the government that was there, that government actually signed lots and lots of free trade agreements with the neighboring countries, mostly developing countries like Vietnam, then Indonesia, then some Malaysia, Mauritius, then other countries. Okay, countries actually that manufacture the same product as India. So a free trade agreement was signed with these countries, and that free trade agreement actually created lots and lots of trade deficit. It didn't help India, it only hurt India. And that was the primary reason why India's imports became so high. Okay. Now, here's the thing, guys. Okay. You have to understand that once these imports or exports, once you are hooked on to a certain client, it's very hard to get rid of them. You have to understand this. Okay. That's why when the imports became so high, so it was next to impossible pretty much for India to get rid of them. This is why, if you notice, just recently, past 2 3 years, India has been on a free trade agreement signing spree, or r- trade renegotiations are going on, like with Malaysia, Indonesia, ASEAN countries, and all. India is renegotiating all the terms that were actually done by UPA government, so that India can cut all this trade deficit, hence increase the exports and lower the imports. Or imports is there where whatever it is, but at least exports needs to go up, right? So that's the primary reason. And the key to this whole entire thing is that India had to sign the free trade agreement with the Western countries, because Western countries are the major consumers. No matter what their economy is, they are the primary consumers. They import the products at a very high rate. You cannot find a market like United States, a market that, yeah, it weighs, there is lots and lots of waste, but still they import, right? At the end of the day, that's what you have to worry about, or that's what you have to care about. Same thing with European Union. It took 20 years just to sign the free trade agreement with the European Union. Imagine how much damage it does to the economy in 20 years. Now, if this free trade agreement moves forward for next 20 years with the European Union and, let's say, United States and all that, what will be the economy? Within 2 to 3 years, India's exports are gonna rise. They will just spike like this. They will skyrocket upwards, right? So that's the whole idea. All right, now let's move into the reason number 4. This comes down to what? This comes down to second way currency becomes weak. That is the structural change. That is a weaker rupee helps export competitiveness, which is a very important factor, that moderately weak currency can actually help exports. Because if the rupee becomes very strong, then Indian goods become more expensive for the foreign buyers. So, for example, right, if the exchange rate is, let's say, 100 rupee per dollar, okay, so a product that will cost 1000 rupees will sell at what? $10 internationally. But if rupee strengthens to $70, 70 rupee, like 70 per dollar, then that same product suddenly costs what? $14, right? So that makes exports less competitive. So the country, I mean, the countries that have already dominant exports, they immediately out outclass you or outcompete you in the exports market. So many countries have historically allowed their currencies to remain competitive during the industrial growth phases. Now let me tell you even more interesting thing here about China, for example. Right now, I think $1 is 6 yuan, or 6 or 10, around that. But you know what's interesting is that China has on purpose depreciated its currency compared to dollar. Otherwise, Chinese yuan actually can beat dollar right now. But the problem is that if that happens, then Chinese exports are gonna drop, take a nosedive, because they will become expensive, right? And that's where the problem is. This is why when China started to notice that its currency is becoming competitive to the dollar, and the gap is closing very fast, so China started to push its exports or trade in its own currency, yuan. Why? So that China can sell in yuan directly and it doesn't have to deal with the currency exchange uh, manipulation for the export competitiveness. Okay, so that's the trick here. And this is the primary reason why countries have to push their exports in their own currencies, just to fill that gap. Now, this is why India has started to internationalize its currency more and more, because they realize that they just cannot keep devaluing their currency just to make sure that there is export competitiveness. Why? See, there are a couple of reasons for it. I'm going to get back to this thing, okay? I'm going to come back to weaker rupee part again, okay? But you have to understand this, that um, when your currency is not competitive, okay, I lost my chain of thought actually. But yes, so India cannot bring its rupee down all the time. There is a limit to it, right? Because if India continues to do so and continues to trade with in dollars all the time, then sooner or later what's going to happen is that, let's say US decides to weaponize the dollar against India. Then India already has a weak currency and US weaponizes the dollar, then India will be completely screwed. Okay? And that's the thing. That's what you have to think about when you are in the imports and export business. And that's the kind of thing we are dealing with here. So, this is why India started to internationalize its rupee as much as they can. I'm not saying that rupee is going to become very strong overnight. And I can assure you that I can guarantee you that it's not going to become stronger until it is until exports are more than the imports. Okay, so India has to increase its exports. Now, this is the primary reason when it comes to exports. This is why India is pushing more and more into services sector, because services sectors and human resource sector is one thing that India dominates. India has the advantage of the military age population, and because of that advantage, India is pushing into services sector, and that services sector is growing rapidly. This is why India is getting more and more into IT. Why? Because that brings the more opportunity for India's service sector. Now, service sector exports is India's sector exports is $300 billion plus. And for services sector, you don't have to invest too much money or to establish a infrastructure that takes 5 6 years in itself, right? Because establishing a manufacturing infrastructure is a slow process, but services thing is all about business deals. If you have business deals with different countries in that area, then you can immediately provide the service, and that is faster. So if India has to play catch up to China's exports, or India has to catch up in exports so that India can outpace the imports, then India has to grow its services sector. Okay. So let's move forward to our last but not least, that is a reason. The reason being that currency systems, they were built before India's rise. Or you can say that late start. Okay. Now, late start is all about the timing. Now, if you look into this whole thing, the India's economic structure and all, you find that it took India 70 years just to get to the GDP of 2.5 trillion. And previous government, that is Congress government used to say that, oh, India will be third or fourth largest economy by 2045 or some. They had some calculations, some numbers somewhere. I don't know how they came up with it, but they did. Okay, so it took 70 years for India to reach this number of 2.5 trillion GDP, but it took just 10 years for India to reach from 2.5 trillion to 4.5 trillion GDP. What does that tell you? It should tell you that this pace can be picked up easily. It's not that hard if you put your mind to it. Okay, within 10 years you increase the GDP by 2 trillion. So that is a very solid number. Okay, meaning that India has that capacity and the capability to pick up the pace when it comes to the economic growth. And I'm not going to go into the timeline of currency powers and all that, and we all know what exactly this is. But my whole point is that it's always about the governance. Like, even though India had the reforms, right? Economic reforms, India began its opening economic reforms and market and all that in 1991. But large scale structural expansion of the economy accelerated much later, right? If you look into it for decades, like after the independence, India followed a much more controlled economic model, so much so that it looked like it is a communist or socialist model that limited the industrial growth. 1989, India was on the verge of bankruptcy. Then it limited the exports, integration with the global markets. Without the integration with the global markets, when you are living in a Bretton Woods system and a petrodollar system, then without the exports, you were not going to get the dollars. That's why India ran out of the foreign exchange. So India had to put its gold, 50 tons of gold, as a collateral for its imports. And then India went to IMF to get the loan and all, and India changed its economy. And even that wasn't enough. Actual reforms started from 2014. And like I said, that as a result, it took nearly 70 years for India's economy to reach around $2.5 trillion. But the pace of growth accelerated dramatically in the last decades. India's GDP expanded from 2.5 trillion to 4.5 trillion in about 10 years, making it in one of the fastest large economy expansions in the world, right? So currency power usually develops slowly over decades. It's not something that's going to happen overnight. And it starts to happen only when your exports are more than the imports. So this way, what happens is that you don't have to depreciate your currency. Your currency doesn't depreciate because you're not selling your currency outside, right? And your bodies like central banks and all, they are not devaluing your currency so that they can have more exports. Okay, so in the end, this is the end of it. Okay, but in the end, what I will say is this: that rupee is not weak because India is weak. Okay, that is a misconception if anyone thinks that. It is weak because India is still a fast growing but import dependent economy. The country imports large amounts of energy, machinery, and industrial inputs from the rest of the world. Now, whatever infrastructure, the export infrastructure or the manufacturing infrastructure that India has put in place, it is still being built, right? The capacity is still being built. This is why I said that building capacity takes time. It's a 5, 10, 15 year, that thing. It depends on how fast you function. So, so yes, it is building, but at the same time, India's export dominance and financial markets are still evolving. Okay, so the real story is like behind the rupee is not just about what you call it, the currency story. It's the story where India currently sits in the global economic system and where it is heading next. Just remember Vision 2047. Okay. So this is it for this video, guys. Please do like and subscribe, and I will talk to you guys in another video. Okay. Take care. Bye.